there's two investments. There's the investment that's the asset, but then there's the investment that's the structure. When you go to give somebody an opportunity, you need to give an opportunity that's the asset, but also a structure that then is given to them, okay? The more somebody gets you money and the more risk they have, the more they will absolutely demand, and they should, that they get more say. Do not be greedy and think that somebody should take all the risk and you get upside on profits and they don't get any say. I would never allow someone to be able to bankrupt me. That's essentially what you're doing if you do that. I want you to sign on the debt, give me all your money, and if this goes under, you take the risk and can go bankrupt, and I have the decisions over that? I see people that actually do this. They say that, oh, I think I should because I'm controlling the asset. And I'm like, that's ludicrous. Why do you think that you deserve that? That person is betting on you. They're risking their money, their time, their opportunities on you, right? And that's a big deal. Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class. When dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process, they are bar none the best. So if you are looking to automate your facility or operate it in a best-in-class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description. Welcome everybody to Self-Storage Income, and we have a very timely topic today because it is probably the thing on everybody's mind. No matter if you are in the industry, you're not, you're a big player, a small one, or just starting out, this is something that everybody's working through right now.
It really is. And like you said, it's very timely. Interest rates have made financing a lot more challenging for people to make sense of. And especially with a lot of these deals and the prices that they're at and those different things, it opens the door for a lot of creative finance and other opportunities. However, regardless, there's a lot of people out there looking and needing to raise capital for their deals. I was just talking to somebody the other day in business acquisitions, and they talked to somebody that had recently secured an SBA loan for like 12% or some craziness. And so with those things happening out there, it's really, really important to be able to get out, raise the capital. I know Pace has talked about this a lot at the events we've had him at, that, man, if you're going to have a skill set out here in the world, raising capital, you're always going to need it. It's one of the top things. So really excited to dive in and talk about this today.
Yeah. And, you know, it's at the end of the day, we have two mechanisms on the capital side to do deals. You have debt and then equity. And most people, the equity portion, which equity, everybody's like your down payment. So you got a down payment on the property costs $2 million. The bank won't give you $2 million in debt. So they may give you 1.5. That other 500,000 needs to be the down payment. We call that equity. And that's people that put it in. That's the equity in the deal that they have. Now, when you look at that, right now, well, always, first of all, in real estate, and commercial real estate, this is an ever-present thing. In real estate in general, in order to buy and keep the machine working, you need both sides of it. Even if you have your own money, usually that only goes so far, right? And so then the question is how do I buy a deal? How do I get my first deal? I don't have enough money. I don't have any money. Or after I get my deal, I used up my money, how do I get more, right? And that's really where the raising capital piece comes in. And I think that this is a hard thing for a lot of people. I think it's tough to wrap their mind around. It makes them uncomfortable having discussions like this. And I know that because that's how I was forever. So we didn't raise capital for 15 years, and it really, I look, if we would have been actively engaged in that, where we would have gone and what we could have done, and the things that held us back were preconceived notions maybe that weren't correct, and how we thought about it, and fear, and we're going to get into some of these things. We're also going to talk about how you get it and where you go to get capital and the right and the wrong ways to go about it. So you have the banking side. That is negotiations between you and the bank. That's just, what's the bank going to give you? How much do you got to put down? What the interest rate? And that will fluctuate.
Mm-hmm.
But because banks give you and say, this is what we're willing to do or not willing to do, it makes it easier almost because it's kind of structured. When you go out to get investors, that template isn't formatted. It's not structured. So a lot of people are like, I don't know, how am I supposed to do this? So it can seem overwhelming, complicated, and generally has a lot of emotions tied to it. And I think it also holds a lot of people back.
Mm-hmm. Yeah, and it makes me think of the ego piece too, because I know, like, looking at whether it's been our own things or it's stuff that I've looked at in my own life, there is that voice in the back of my head that's like, well, just because I don't have or don't want to put my own capital into something, it's like, it almost feels like, oh well, I should just have it. Like I should just have all of it and be able to do whatever. It's like, but that's not real.
Yes.
And like you pointed out, no matter what point in the game, you are going to need that resource if you continue to grow and scale and continue to invest. You're going to need capital. And again, in my mind, I mean, there's not really a whole lot of difference going to a bank and asking for money and going to investors and asking for money. There are a lot of times that, or always, that people aren't going to be liquid to the point of just having all of that cash on hand, right?
Yep.
And on top of that, you have the benefits, talking banks and investors and all those different things of leverage, which is a massive tool.
Yeah. I have a name for this. I call it poor man's pride.
Yeah.
And poor man's pride is a pride that stops them from growing and stops them from working with others and stops them from achieving things. And poor man's pride is generally around this idea that I have to do things on my own. And I should just be good enough. And, this holds a lot of people back. First of all, it's not real. That's not the reality of the situation. And it is really embedded into our culture a lot through how we discuss business, finance, and the hero's journey, the archetype of the entrepreneurs that we make it, right? Like, you have this entrepreneur and he did it all by himself, and and he came. That's not actually true. It's never true. It's never been true, right? There's so many things to go into play, and they are actually experts at accumulating and dispersing resources. Because if you're trying to build something, you can't do it on your own. Mm-hmm. You can't. There is no such thing as on your own. If so, you don't have customers, right? It just doesn't work.
No
like
way.
that. And so, first of all, if you go to a bank, you're also not doing it on your own. You shouldn't do it on your own. That's a very dangerous thing. And when you find people that have that mindset, those people scare me. I don't want to do deals with those kind of people. Mm-hmm. Because it means that they're putting their own ego first. And that is like a death sentence in business. And so you really need to watch out for it. And this comes, though, to the idea of raising capital. And once again, I'm openly saying I was a victim of this. I thought, no, I have to be done on my own. And my thought process on it, though, a lot of times was not pride, but it was also fear. I was really scared. I was scared to lose other people's money. Still am. Terrifies me. To a point that I would lose everything before, I even want that to happen or allow it to happen. It's never happened. I've never done that. Never lost my money in deals, never lost other people's money in deals, anything else. But when I was having a discussion, I was actually at a mastermind, and I was like, I'm scared to lose people's money. And two, I'm scared to ask people for money. And it was brought to me, and I was told, they said, AJ, have you ever lost your own money? No. They're like, what's your average return? And I kind of walked through it. And they're like, so you now have, over 100 million in assets that you've built, you've grown, you've made all of this wealth, and you've put yourself in this incredible position. You haven't lost deals, you haven't gotten into trouble, anything like that. And then you're not taking other people's money because you're worried, right, about that. And they said, it sounds to me like all you're doing is preventing other people from opportunities. And I hadn't thought about it like that. And they said, you don't ask people, not that they said, I guess my interpretation of this was that an understanding of this was, I don't want to ask people for money. I want to offer opportunities. Mm-hmm. And they made the point, they're like, other people want to have what you have. They want to follow in your footsteps. They want to have access. You're just not allowing them to. Now, did you know that you would make, there was a chance that you would have lost all your own money? And I was like, yeah, of course, right? And they're like, but you didn't, everything else. And so you're not allowing other people even the opportunity to do that. And that really changed the way I thought, where it was, I'm not necessarily asking people to give me money. Mm-hmm. And that's not, and I don't do that. I have an opportunity. It's something that I've done for decades, right? I'm using it. Would you like to come and take place in this opportunity? It has risks, of course. That's why it has upside. Mm-hmm. So I'm okay with these risks. I take them on. I do it. If you are too, you can get an upside to it, right? Now, this idea that also, though, people need to be big boys and girls, and they need to accept responsibility as well. This is direct investing. This is not like, we don't want you to give us life savings. No, you need to be responsible. But I also need to entrust and believe that people can make big boy and girl decisions. Mm-hmm. And so they're like, you're downgrading the people, and you're not allowing them access to opportunities. It was a totally different way of me thinking about getting investor capital.
It's such a great way to put it, man. And again, going back to the ego, it's like
Yes.
You're thinking about how you feel and what your impact is, and not what you could be doing for others.
Yes,
right?
not
like,
what I'm giving,
yeah.
Not what's there.
Mm-hmm.
And, they were like, are you doing it for the right reasons? Are you doing it, all those kind of things. And it was also ego. I had this name, and I had this thing that I'd built and done, right? And all of a sudden it was like, well, what if they don't like it? Or what if they're mad? Or what if that hurts me? Right? So once again, it came back to those things. And we had to really weigh out our options. And what were we trying to achieve? And was this thing holding us back from achieving it or not? Because there's another thing that, not everyone should raise capital. If you don't need to, if it has nothing to do with your goals, of course, right? That's very few people, because very few people have the opportunity to not have to do that.
Right.
So most 99% of everyone here listening has to do it just to play, right? Whether you're starting up a business or anything else, that is price of admission to the game. And so it's kind of a built-in process here. Now, I actively avoided family and friends when I started out. That is the opposite of most people, and actually the opposite of what I suggest. I was able to do that because I had a resume, right? Now, that also meant then I was dealing in security laws, because what happens is the way that I was raising money, disclaimer, I am not a securities attorney here. You need to talk to a securities attorney, okay? So
massive disclaimer,
everybody. But I was raising capital from accredited investors, and there's all sorts of laws that need to be done. What I learned is that scared me actually became like this huge thing that was, it made me feel great. Why? Because there were rules. They're just things. Here, this is what you do. This is what you don't do. And by the way, you can do all of these things. Just do it right. Structure it the right way. And then you can do like anything you want. And I was like, oh, wow, I didn't know. I didn't know there were so many options. I didn't know there was so many things I could do and how easy it would be. So, we went down that road. And that road was a decision that took a really long time for me to come to. And frankly, it was made after I was out of the hospital. I'd been fired from my job and I had this great benefit. And that's what really made this idea of that people, right, need opportunities to have like what I had. So I think first and foremost, if you're raising capital, it needs to be in line with your goals, but also you need to be doing it for the right reasons. Now, for most people, it's, once again, you have to. And so then you need to decide how about that you're going to. The other thing is you don't want to ask people for money, which I don't. I don't want to ask anybody for money. I want to share opportunities, though. And I actually do. That's something that excites me. We're doing podcasts. I love the idea that we're sharing with people opportunities to do things. It really excites me because I think it's awesome that other people, it's like, I want to tell you about this. This is so cool, right? So for me, I could get behind that where I'm like, yeah, look, I have this amazing opportunity. I'm excited about it. I'm doing it. We're not. If you want to do it, great. If you don't, whatever. It's not an opportunity for you. It's not personal. It's not anything else, right? And so just approaching it right made that way. For most people starting out, you're going to go to friends and family. And I think that when you do that, you first of all need to have things be very clear, very professional. You need to have you need to pull the emotion out of it. You need to pull the family relations, friends, things. It needs to be very clear. This is a investment. This is a risk. You're doing this to invest and get an opportunity, but not a guarantee. You'll never be guaranteed anything. If you're not okay with that, don't do it. So make it very clear. Make sure everybody knows, right? Because it's not that you will lose the money or anything, but that's how it should be approached. And then from there, it needs to be done by attorneys. You need to have very specific documents. For me, it's more sensitive when it's family and friends. So it's just, you need here's our lanes, here's what we're doing, here's what your capital is used for, here's how it's going to work, and then just abide by it. But then, once again, you're sharing a structured opportunity. I think too many people, the reason they don't want to raise money is because they hear horror stories, and what they're doing is, we're just all going to come together and buy something, and then hope it works out. And it's like, well, now who's doing what? Who gets what? And it's confusing. Nobody really understands things. Of course, that's going to be a nightmare. Of course, that's going to end wrong.
Well, too, and I think people have the misconception that it's like, oh yeah, well, I've always been best friends with this person, or this is my brother or sister or mom or dad or whatever the situation is, and they think, well, yeah, we'll be fine no matter what. Like,
no matter what. Yeah.
You're 50-50, I'm 50-50, and like another thing too, going to the point of talking about who's doing what at what points in time, like really identifying who's bringing what to the table and what those resources are and what the value of those resources are when you're splitting up equity in these other pieces, right? But then also that the idea that you're going to go into a deal and just say, oh yeah, we'll just go into it. AJ, me and you will go into something 50-50 and we'll just do this and everything will be rainbows and sunshine. If you think it's not going to be complicated once you have millions and millions of dollars on the line, 5 years down the road, it's total opposite. Things are going to, it's like, oh, well, we'll just be making so much money. We won't have to worry about it. We'll be fine. And, if you get way more money than I do or this or that happens.
Nobody will care. Dude, it's not going to be broken promises. No, none of that will happen.
Yeah.
That is so naive, immature, and you trust through contracts. Okay, everybody? You trust through contracts. Everything needs to be spelled out, detailed out. You need to start with the divorce. So you need to start saying, what happens if this blows up? What happens when this ends? It can end as a sale, it can end as failure, everything else. Do we all know exactly what happens when this ends? And are we all okay with this? And then how does this progress? Who gets what? What is actually required? If you're partners, each one of those partners needs to have something they have specifically. What is your role? What does that mean? What is the return that goes to it? And how does this play out? Details, specifics on what rights and what obligations, who has say and why. If you have somebody that gave 10% of the money, do they have equal say as someone that gave 50% and is doing all the work?
Exactly right.
Because if that is not figured out, when it comes time, that's a fight.
It is. Well, now we're really getting into that discussion too. When you're talking raising capital, splits, and those different aspects, we're talking LPs and GPs too,
Yep.
right? And how all that's structured. A lot of dynamics.
A lot of dynamics. And I think we get confused with complicated as options. And what I mean by that is that it is only as complex as the fact that you have lots of things you can do. So it is complex in the terms of options, but you don't have to make it that way. You can actually make it much more simplified, and that's what we did. And when learning that, actually, I was great. Okay, I can give capital partners, they can come in, and they can be capital partners. They have limited risk. They have no say on these items or whatever that may be. Everybody knew exactly their lane, what it meant, when information go. So it actually made it clearer to me than before how I thought it was, and how things would play out, who had what responsibilities, if things went wrong, who was on the line. So the deals that I see that go bad with partnerships and raising capital are almost always because it's not clear, it's very vague, there's no separation of individuals, roles, responsibility, liability, there's no definition on why, and it's more broad and open, and it's we all like each other and we trust each other. That is a disaster. I don't know that I've ever seen people that came together and said, we all trust each other and like each other, and it did not blow up. In fact, that is probably the worst spot you could ever be in. That sounds so contrary. Because we like each other and trust each other, that means it's going to work. No, actually, the moment you say that, that means it's not going to. Because we all have different ideas of what things are going to do and how they're going to play out. I have different needs. One person has different life circumstances. Those all play into it. I need money. I don't. I'm a long-term investor. I'm a short-term investor. I have say, you should be working, but you're not. I should get more of a return now, on and on and on. Because the deal, the markets, everything will change from how you started. So if you all agree at that starting point, that's great. That doesn't mean you're going to agree on every single stage because it'll all change. And how can you know that when you haven't even been in the circumstances in which it'll change? It always blows up. Always. You need to have very clear defined documents and how everything will work. Then you're giving an opportunity to invest, and then you're also giving the opportunity, though, in how they invest, what it means.
Yep.
This is the opportunity. You will participate in this way, and this is how it's going to work.
Giving them a package, right?
Yes.
Showing them and talking simplification.
Very simple.
We were just talking recently about some of the raising and different things we've got going on, but do you want to run through the structure that we've got currently? Because even from when we started to now,
wildly different.
We've done a lot to simplify.
Yeah.
Talking, if you want to share a little bit about
Absolutely.
like the 70-30 split and how we've really broken down one of our most recent raises.
So we adjusted one of our most recent raises, and I've done different structures on different deals because we had different investors, different plans, things like that. Like, for an easy way to think about this is our development deals are handled individually. We don't do like portfolios, we don't funds, and because there's so many different things. You have different partners. Well, before, how we set our structures on a simple premise. That premise is aligned with our strategy. And so there's reason our deals are structured the way they are. It's not just like, oh, well, we looked at the market and this is how people are doing deals. No, we have a strategy and an outcome we're trying to achieve, and we structure the deal based upon us achieving that. So our goal is to get to be able to compound our and our investors' money. In order to compound, we need to get our original capital back. That's velocity of money. We need to get it, turn it over, and put it in place. But the original source, we want to keep growing. We get the original amount, the original source is growing, we reinvest the original amount, why the other source is growing, and it's growing. I call this stacking. So that's the whole point to achieve it, right? That means that our goal is within our first 3 to 6 years to get 120% return back. And then from there, we want another, and we do that generally through a refinance, because the reason we do that is it's low, you don't pay taxes. So we look at the net return, how much you actually take. Now, with that structure then meant LPs coming in, our investors, they come in, they get the same thing we want to get. After they get their money and profits back, we don't dilute them. So all other investments that we've seen dilute it down. That means your equity position, everything's diluted. We would change a split, meaning part of the profit, we would get more as a reward. So in order to achieve that, get everybody profits money and do really good, everything, we got a little more of the profits after that point. But they didn't dilute, right? Well, that is called a waterfall. What we did on this new one to keep things very simple, we did none of that. We didn't flip anything. It was a straight 70-30 split. And then we gave what is called a preferred return. Let me break this down, everybody, so it's not getting complicated. All you're doing with structures is you're defining few things. First of all, what the roles are. Second of all, who gets what equity. Third, how returns are split and how they're going down. And then fourth, who holds risk. Okay, that's it. So when we look at it, LPs, they don't hold the risk and they don't make management decisions, right? They don't get to decide those things. So they're the capital investment. So what split of the equity they get and when do returns come to them? That's all all the structure is and all we're deciding. So for us, we have what's called a 70-30 split. Now that means that 70% of all the profits go to them, 30% of the profits then go to us. But that is after they get what is called a preferred return. So we give them a 7% preferred return that is cumulative. So every year, on the deal that we have out right now, it's like every year they're going to get that 7%, right? So they get 7% return on their money. If the asset doesn't produce that 7%, well, it's like a makeup. Well, then as the asset makes money, they'll make up for that 7%. So 7%, 7%, 7%. That means the people that are invested their money are going to get a 7% return on their money before there's any profit to even be split. Mm-hmm. So that means we have to make profit on top of giving them a cumulative compound or 7% return. And then after that, it's split. But that's it. So the investor comes in, they give us money. They know they're going to make 7% a year. And if they don't make it one year, it's going to roll over to the next year. So they still get it. And then after that, profits above and beyond that get split 70-30. And that's how we get it. So we need to generate returns. We need to keep them getting 7% a year. Plus, we need to deliver profits on that so we can get paid. And then that's it. That's just flat. The investor knows they're making money off their money, so their money's working for them. Even if they don't make it, they're going to get it over. And then above that, they're getting profit, and I only get a share on top of that profit after I perform, after we do our thing. They still get all their money back. We're still shooting for the 3 to 6 years, 120% return, but it's still 70-30 forever. Mm-hmm. So they're not diluted. Nothing changes at all. The profit split doesn't even change. So they're locked into an asset. They're going to get all their money back. They can compound it. And then they get that. If we sell, the reason we would sell would be because somebody's going to pay us so much money for it. They still get the same split. It doesn't change. They're never diluted. Mm-hmm. This is a simplification. And yes, that's really good for the investors. They take no liability. None. That's all on us. And we need to perform, which we're happy to do because we know we can, mm-hmm. right?
And we do.
We do. And two, the money as LP investors is also ours. We have $2 million in this deal, I think, right now. So that is our money alongside theirs. So we're getting our returns like they are, right? This is a simple version, though, of how you could set it up. Mm-hmm. What we did is said who gets what equity. Right, so that 70-30 split on profits is the split on what it gets as the equity holders. From there, you get who gets money first. All capital investors get 7% first before anything else. From there, it goes to an equity split. That's forever. Really simple, straightforward. They get accelerated depreciation, and that's all lined up. But the point being is we outline this. Who gets depreciation? Who gets decisions? Who takes the risk? And who gets what equity? And when do they get money? Very defined. Very, very clear. So when we give an opportunity, your opportunity is to get a hard asset. You get all the benefits of it. You get the depreciation. We accelerate depreciation through cost segregation year one. So you get huge tax write-offs. We had in our fund, I had a guy called me up and he's like, yeah, I made a like a 50% return just off my taxes on my investment in year one because the depreciation was so high for him. It's individual, happens to everybody, and it's different for everybody. But the point being is that's a huge benefit that the investors get. From there, they go, all right, the next part of the deal is, am I going to make money off my money for giving you it? That's that 7%. Then profits, I get 70% on top of that of all the profits. And are you kicking me out? Are you diluting my equity? How's that? And then that never changes. Very simple. Tax benefits, I make money on my money before anything else happens, 7%, and that is cumulative. It happens every year. If you miss a year, you make up for it on another one. After that, when profits come, after I've already been paid, it's a 70-30 split, and it lasts forever. Very simple, easy to understand. When you're starting out, simplicity is best, making it very clear. So when you go to ask somebody, though, you can see the difference in saying, if I went to somebody to ask for money, I have an opportunity to invest in a storage facility, and this is the opportunity from the storage facility perspective. Here's the asset. Awesome, that's great. Do you want to give me your money? Yes, I'll give you money. But then you have to have conversations now of, okay, well, who gets what equity? And when am I getting return? And how is this all working? Who's getting the depreciation? When are you going to sell? And can I demand that you sell? Can I make decisions? What says do I get? As opposed to saying, I have an opportunity in this storage facility. Look how good of an investment this is, an opportunity. And here's your opportunity as an investment in this deal. You get a 7% cumulative preferred return, right? Profits are split 70-30. We refinance, you get all your money plus profits back within this time frame, and then no dilution, you keep it forever. So now you have the asset that is the investment, but then you also have the structure that's the investment. Now, the thing that gets complicated about this, that people are listening to trying to understand, is we picked that. We made that to give to investors. When starting out, you may make it way simpler. I've heard of people that went in a deal and said, we split profits 50-50, but you get all the tax benefits, everything else. Some people are okay with that, right? Then I've had other people that just said, no, we're going to just do a 70-20 split of profits, and there's nothing else. And the investor gets a lot of say. When you're starting out, normally a big investor is going to want say. So the way we do it, or the way I believe it should be done, is you carve out and itemize what they get say on. We don't want too many cooks in a kitchen, so day-to-day operations, you don't get say on. We're going to run the facility, we're going to do the asset management, but if we need to sell it, if we need to change anything with the banking, if we need to refinance, if we want to get another loan, or any decisions on CapEx above a certain amount, that investor now gets say in it. That makes sense. I would demand that. And two, I would also, if I have a new investor and I'm giving all the money, I would also basically have in there, I can overthrow you at any time. Now, some people are like, well, I don't think you should be able to do that. And I always say, well, hold on here. It's their money. You're getting profits. You're getting, those kind of things. It's just rare that somebody's going to write you out a $2 million check when you've never done something and they're risking all their money. They've got to be on the bank. So they're also risking on the debt. So they take all the risk. Of course, they're going to have say. If I have to take all the risk, and this is why, guys, we have our quadrant. And I made a YouTube video of this and how you do partnerships. And the quadrant is basically 4 sections in deciding who gets what and how you do it. You have the opportunity, right? You have the money, you have the risk, and then you have the execution. Based upon those 4 quadrants, we will decide who gets what. And it's really easy to look at, and I break it down. The structure, once again, this isn't based, well, I want more, or I think I deserve. No. Who brought the opportunity, who's bringing the capital, who's taking the risk, and who's doing the work. Line item it, who gets what say, who gets what equity, and who gets money when it comes out. Then we line out the strategy. Here's the strategy. We're going to buy it, build it up, and sell it in 3 years. Now, when we do that, who has the means to change the strategy? So who has the means to say, we're not doing this anymore, or we are doing this? Who can affect, who can stop the sell, everything else? Structure goes along with the strategy. Whoever's making the decisions, the work, the deal brings the opportunity, right? Then you split it up. I hope the whole point of this is, though, there's two investments. There's the investment that's the asset, but then there's the investment that's the structure. When you go to give somebody an opportunity, you need to give an opportunity that's the asset, but also a structure that then is given to them, okay? The more somebody gets you money and the more risk they have, the more they will absolutely demand, and they should, that they get more say. Do not be greedy and think that somebody should take all the risk and you get upside on profits and they don't get any say. I would never allow someone to be able to bankrupt me. That's essentially what you're doing if you do that. I want you to sign on the debt, give me all your money, and if this goes under, you take the risk and can go bankrupt, and I have the decisions over that? I see people that actually do this. They say that, oh, I think I should because I'm controlling the asset. And I'm like, that's ludicrous. Why do you think that you deserve that? Why do you think that, you know what I mean? So
lack of experience.
Lack of experience. Yeah. You have to pay to play. And a lot of times those first deals, you're working for profit, but you have little control, you have little say, but you're earning your stripes because that person is betting on you. They're risking their money, their time, their opportunities on you, right? And that's a big deal. It's a really big deal. And you're lucky if somebody's even going to be willing to do that. I know people that have done it and basically taken no profit and earnings just for the opportunity to get an investor into an asset to build it. Because then the next time, guess what they get to do? They get a deal to structure and it gets more and more beneficial to them. They get experience, they get more capital, they can grow and build a company. So when you're starting versus the end, totally different. If you're starting out, you probably aren't going to get the structure that I'm talking about. It's also different on who you get money from. If you go to institutional level, big boys, companies that syndicate, first of all, they're probably not going to give you your money if you have no experience. But second of all, they're going to have all control, all say, and they're going to use it at will. If you go to high net worth individuals that are giving you $1 million, $2 million, they too are most likely going to want most the say. And they'll be able to overthrow you. They're going to be on the bank, everything else. If you fractionalize that and go to friends and family and have smaller check sizes, lots of times it's opposite. Now you can actually dictate things. You can actually have the say, and you can make it so investors can't do things. One of the reasons why we do not allow investors to have say is because if you're giving me money and then I have 15 other people that are giving me money, they don't know each other. You gave me your money. So if you gave me your money and I let Bob, one of the investors, now have say and dictate, you don't know who Bob is. You're not giving Bob the money. I can't let Bob have say because you're giving it to me, right? So it's also a way to protect other investors. That's why you do it. So they're not sitting here going, wait, hold on. Bob's now deciding we're going to sell. Who's Bob?
Exactly.
Right? Like I didn't give Bob my money. I gave you my money. So when you fractionalize that equity and when you don't consolidate that risk and that equity, you have usually more control and power. That's the basic framework, though, of how we look at investments. Other people do this way simpler. They go, I need $300,000. Dad, you got a 401k. Give me your $300,000. We'll split it 50-50. I'll do everything. I'll find the deal, the work, everything else like that. Dad's like, great. Sell it in 3 years. I get 50% of the profit. And you get it. That happens all the time. Other times people go, give me $300,000 and I'll give you an 8% return over the 3 years after we sell it. It's backed by the hard asset. Somebody's like, okay. So you can make this as simple or as complicated as you want. The only question is, will an investor do it?
Right.
That's the question. If they won't, then you have to create an opportunity that they will in order to play the game. I don't know if that makes sense.
It really does, man. That's a really great breakdown of all of it. And one of the key aspects that comes to mind as you're talking about that, you hit a lot on the day-to-day operations, making decisions, all of those things. Can you touch a little bit on how we've structured things both now and in the past to, because when you're talking to investors, obviously a lot of times you're going out, you're raising capital, you're probably going to be managing the asset on your own or with a company of some kind, third party, whatever that is. But just painting that picture for everybody to show how we've not only structured the deal, but how we've also incentivized us to perform on that deal.
Yes.
And being able to sell that to investors when you're talking to them and saying, hey, here's all of what you get. Yeah. And by the way, yes, I'm getting, let's say like in our case, we're getting a management fee or whatever it is, right? Like how have we incentivized ourselves to really perform and do well on that asset?
Yeah. If I have three things, I say this all the time. If you want to predict the future, all you need to do is understand the person the conditions and the incentives, and you will always know the outcomes. And so when I look at this, incentives are very important. And I find a lot of times investors get this very backwards, and it shoots themselves in the foot. They think they're getting something good and they're not. It's like they think they need to win on certain items, which has always been strange to me. So let me explain how this works and how I've seen this play out very, very poorly. So first of all, we get fees for work. Remember, in the 4 quadrants work. Well, we obviously have a large company that has to execute on all of this. So our deals, like this deal that I was talking about earlier that we have, that was an off-market deal that we got after a year of negotiating and finding this deal.
And a lot of problem solving.
And a lot of problem solving. We had architects on this. We had our construction people, our property management people. We had our debt brokerage on it. I mean, this was legal. This
Everything.
was hundreds of thousands of dollars, right? That we had to put in to get this deal. It's a killer deal. It's under replacement cost. It's brand new. It's on major road. But the point is, though, we had to work to get it. Then in order to close the deal, we risked all our money. We had to put our capital out. We invested millions of our own money, right, and to get it done. I actually have to pay, though, all these people to do this. So people are like, oh, well, you should just get paid off the profits, right? Well, first of all, that's not how anything really works at all. And the profits, when you invest, don't come. It's not like one for one. And what I've seen is I've seen people start out, and that's what they thought they would do. They'd say, I'll sacrifice fees to do the work and just make money off the profits. Well, first of all, I tell people, you invest with me not for good times. You don't invest with me because things are going to go right. If that was the case, nobody would give me their money. You just go buy the asset and you'd do great. If you knew that things were going to go good, just go buy the asset, right? You invest with me because that's not how it works. Look at the conditions we're in right now. People invest with me for when things go bad because I know what I'm doing and we can operate it. That's why all our properties are making more money and occupancy is going up. And we make hard decisions in hard economic cycles. And we risk our money and capital and our people work to protect them. So first of all, we work, right? That's why you invest with somebody. It is. And if you just knew, if I knew the stock market was going to go up and I knew which companies were going to succeed, you would never need anybody. So when things don't, though, plan, that's why you do it. First time, I think syndicators or fund managers, they are people that are trying to do it. They're like, well, I won't get paid. Then what happens is they're like, all right, you have to invest in the asset. You have to build the asset up. The profits that are generated, right? You have to increase it, and it takes time. The profits split that you get isn't huge. We're talking 30% of a profit. Well, a profit is a fraction of the total capital allocated. So if you invest $1 million into something, and that $1 million gives you a 5% return, that's $50,000. If you're taking a 20% split on $50,000 a year, right? I mean, that's not a lot of money. $10,000 a year, right? That's great. And you hope that you're going to make more than that, and you hope there's going to be. That's not 10,000. I got that wrong, but
a little more.
A little more. But it's not even the low end of salaries, you're not even hitting. You're down below, meaning you can't even live off of it. More or less, hire people and actually do a good job. So then what happens is when they do it, the moment things go wrong, and the syndicators or the fund managers are like, we're not going to make money for the next 2 years. I'm not ever going to make money. I can't do this. They sell the asset off, even if it's a loss. Even if they shouldn't, even if the property was going to be fine and make money, because their investors are taking the loss, not them. But they have no upside. They're not making any money. And two, what that means is every year they're losing. Now I have to pay for everything. I have to work for free. So they're actually, what you've done is you've put that syndicator in a position where they're going to lose. So now all they're deciding is, do I go under? Do I go bankrupt because I can't even afford to live? Or do I just sell it at a loss and my investors take a loss and I throw it back to them? Well, of course, they're going to take the investors because they can't even live. They literally don't even have the financial means to do it. Even when the asset was not a loser, and it shouldn't have been a loser. This happens all the time. What happens is the investor thought that they were getting something because that person wasn't taking a fee. So they thought, I'm winning because they take less.
Right.
That's not how this works. You don't win when your partners don't win. And you don't win by cutting other people down. That's not how this works, right? And then that blows up in their face, and they thought they were getting something when instead they've incentivized that person to actually what they might view as screw them. And it's like, well, you kind of screwed them at first. So why are you surprised they did it to you? You know, this can be really bad and really tricky. So first of all, we don't make money necessarily off our fees. We haven't. That's something that pays the bills to get things work done. All our money and capital, everything else is invested in. We use that though to keep lights on and to be able to perform and get the returns that we do, to hire all the people that you have to do. Second of all, if you don't have that person there, you have to pay for it anyways.
Right. Exactly.
That's not a payment that you don't have.
Yeah, it doesn't
you have
just
it
go
anyways.
away.
It's just you pick.
Yeah.
So like for us, we charge a 6% flat management fee. You got rid of us and went and hired Extra Space or anybody else, doesn't matter. You're paying 10 to 15% of gross income. You're going to double your expenses. You still have to pay people to do all the things. So it's still there, right? And those are short-term thinking at extraordinarily devastating long-term consequences. Assets don't just go straight up. They never have. You have bad years, you have good years. That's how it works, right? And you want to invest with somebody that has the wherewithal, the resources and ability to not only stand, but to provide options and get through bad and hard times. So you don't lose your money and you actually make money. But it's not every year. We've never had, if you look at our 10-year asset performance, right? Our minimum performance is very, very good. But during that length of that 10 years, there were always years that were down years. Always. It surprises me when people don't think that that's how that's supposed to work.
Cycles, man.
Cycles.
Yeah.
And that's fine. We understand it. Everybody should understand it. But they always come up and we can maximize the asset. We're looking at core value and we're trying to build that value up. I don't care if we have a year or two that are down years and we don't necessarily have distributions in 10 in which we're getting 4+100% returns. Why, that shouldn't matter because you can't control outside forces. Every good investor knows this. Long-term core value creation, not short-term quick games. If you do not have a structure in place that incentivizes that people, those short-term fluctuation stuff is devastating for the investor. And you're actually not aligned. So fees are something that I look at and I'm surprised when anybody debates it at all because it's like, well then, because you have it anyways, no matter what.
Yeah, exactly.
It never goes away. Who are you paying? Then to think that somebody should work for free, even though if they weren't there, you'd have to pay somebody even more to do it. That doesn't make sense to me. But the second side is then the incentive on the equity or the distributions, right? The return. Ours are set up to where we are incentivized to generate above certain returns and performance. And we have to. I have to do that to make my money, right? And we're okay with that. We like our incentives to be completely aligned. Also, we take on all the risk. So our investors, they risk the capital they put in, that's it. Everything else we risk. So we risk our capital we put in, but I also risk because they come after me. The banks, everything else that can go wrong. We have all that risk. That aligns us with the investors. I need to perform. The downside's mine, so I definitely don't want that downside. They are disproportionately affected on the upside, and I am the downside, but then I get that extra piece of the profit. That's my incentive. That's why I'm working. That's why I'm going to perform. That's why I need to make it all worth it. And so when you look at those structures, the incentives that are in place are very, very important. We've always viewed our investors as ride-alongs. We're doing the same thing. It's our money, their money. We're all going together. They're just with us, in the same boat. So if our structure hasn't changed when we didn't have investors. It was the same strategy, right? So we built a structure along the lines. When you're formulating then your structure, you've got to understand where are the incentives, who wins and who fails, right? And when you're investing with somebody, you really need to say, is this structure, what incentive does this person have when things go wrong? Are they just going to sell it and take a loss just to get rid of it? Are they, are they incentivized to actually keep going, to work through this? How's that all work? That's what you look at when you're looking at this structure, because things will always go wrong. Always. The markets don't work how you want them to or think that they should. The question is how that structure will play during those times. And you want an experienced person that can operate within those times and be incentivized to protect you and to make money.
Yeah, man, beautiful stuff. I've really enjoyed watching the progression of us working through a lot of these different aspects, from the deal structures and conversations with investors, and so many just golden nuggets throughout that whole entire piece that you just shared. And so important to also not only understand what you see as a capital raiser, but also what investors are seeing and expecting as well on the other side. Just a perfect example was that thinking that you're getting ahead because somebody's not getting their fees, right? Yeah. And it's just because I've heard that question before, where it's like, well, how come you guys are getting this fee and this and that and all this stuff, from the investor's perspective, and it's like, well, like exactly like what you said, the cost is there. Like you're gonna shut off the lights, shut off everything, cut the utilities off, get rid of. I mean, then what?
Then what? The asset just collapses.
Exactly.
You lose all your money.
Yeah.
Well, and it's funny because I had somebody once say, they're like, well, you make money anyways because you get fees. And I'm like, do you know what 2% asset management fee pays you on something that makes $600,000 a year?
Yeah.
You think we're making, first of all, that's kind of ridiculous.
Yeah.
You know what I mean? And we don't have profit margins. Our other assets and our other businesses supplement the core thing. It's because for us, we own all our assets. Our property management is ran and paid for by our assets that we own without investors. So 60% of our entire company, all of those things are paid for by us alone. And so it's interesting, though, the way short-term investors think. Yeah, that person's really killing it off a 2% fee on $600,000. Yeah. Can you live on that? More or less make money? No, you can't. You can't even live on that, right? So I think that you need to put yourself in that position, and you need to look at that and say, what am I getting? Why are they incentivized? When I invest with people, when I have business partners, and I just bought a company, and the company, the owner had whittled his salary down so he could make it was kind of in distress. And I was like, the first thing we're doing is we're moving your salary back up to this point. My investment money is going to go in. We're clearing out the debts. So I bought the company. I'm clearing out the debts. I'm doubling his salary day one. That's being paid out of my pocket. The reason being is I'm like, dude, if you're not happy, this isn't going to work. And I need you to not worry about things at home. I need you to go out and crush this company. You need to win so I can win. And I think there's a lot of short-term thinking people, as well as a lot of people that are in this world of, I win by you losing. That's very dangerous in investing. That's not how markets work. I don't win when my competition down the street's losing. If my competition down the street's lowering rates and has high vacancy, that doesn't mean I'm winning. If they're crushing it and have high occupancy and high rates, I am too.
Yep.
Right? So incentives are really, really important in how they're placed and what people do. And a lot of times we vastly overlook at that. Once again, we structure it in general. Everybody just take money. And then we're surprised when conditions change and their incentives are a certain way, that they make a decision that is contrary to what you want. Which for me, I'm like, once again, I can always tell the future. Who the person is, the conditions they're in, and the incentives they have will always tell you the outcome. It's the same thing with investing. Who is that person? What's their experience? How have they acted? Are they an honorable person? What is their default settings? I call it default settings. Who are they? That's their default setting. Put that person in certain conditions, good and bad, and show me their incentives, and I can tell you every time what will happen. It's not complicated, right? And I see guys that structure these deals, and they're like, you take this person that's a good person, everything else, but then you put them in horrible conditions, and then you put incentives for them that say, this is only going to be bad for you, and it's only going to get worse.
Yeah, set you up for failure.
Yeah. And you're like, why did you think that they should? And two, if you put that person in those circumstances and those incentives, why are you surprised when you also got hit with bad things?
Yeah.
It's shocking. But there's a lot of people that think this way. I see it all the time. I mean, you see, go on Twitter and look up people bashing on people that,
Twitter.
you know, it's wild to me.
Freaking dumpster fire.
Yeah. And that's a short-term gain that doesn't have long-term outcomes. The goal's to win.
Yep.
And everybody win together and win well. That means you have to survive bad times, and means you have to perform in bad conditions. If you do not have a business, an investment strategy, if you do not have a property management company, asset management company, if you do not have the resources to survive in those bad times, you can't expect to win.
I love it, man. Good stuff. So AJ's going out starting today, raising capital. You're going to family and friends.
That's right. Family and friends. That's it.
Yeah.
So, yep.
Awesome, man.
Hey, hope this was helpful. That's
stuff.
our insight. Everybody's dealing with it. I hope that gives you something to take away, though, and go out and get that capital, structure deals that are win-wins for everybody. And let's all make some money, and let's take advantage of the opportunities that are out there, because like our last deal we're talking about, we're seeing awesome opportunities.
Heck yeah. Thanks, everybody.
Thanks, everybody.